Hi everyone, and welcome to our first of 3 lessons in our Unit 8. This unit talks about funding, and so this particular lesson starts with sources of funding. So our objective for this lesson is to analyze sources of funding to assess their suitability and determine the potential benefits and drawbacks of each option. So some funding options. Now, funding needs is the total amount of money required to finance your project or your business idea. And there are different sources of funding, and they include personal financing, grants, scholarships, crowdfunding, venture capitalists, angel investors, small business loans, and something called microfinancing. And so we're going to talk about each one of these individually, and we're going to start with personal financing. This is utilizing your own funds or resources to finance your project. Now, some pros to personal financing is that you are using your personal savings or loans from family and friends. You retain full control over your business decisions without any external interference. Cons, on the other hand, is that there are limitations in terms of the amount of capital that you can raise, potentially restricting your ability to scale your business quickly. Next are grants. These are financial resources offered by organizations, government agencies, or foundations with the purpose of providing support for particular projects or activities. Now, some pros with grants is that they provide non-repayable funds, allowing you to access capital without the burden of debt. Grants are free money, basically. But the cons is that they often have a highly competitive application process, and the availability of funds can be limited, making it difficult to secure the necessary funding. On the other hand, there are scholarships. This is financial aid granted to students based on specific criteria such as academic achievements. Now, the pros for scholarships is that they provide non-repayable funds, allowing you to access capital without the burden of debt. But again, they also often, on the con side, they have a highly competitive application process, and the availability of funds can be limited, making it difficult to secure the necessary funding, very much like grants. Another source is crowdfunding. Now, this is a modern approach that harnesses the power of online platforms to gather financial support from a large number of individuals by reaching out to a broad audience through social media and other digital channels, and inviting them to contribute small amounts of money toward a specific project or a cause. You have websites such as Kickstarter or Crowdfunder. These are examples of those crowdfunding websites. So some pros to crowdfunding is that there is market validation and customer engagement. These crowdfunding platforms enable you to gauge the market interest and validate your business idea while engaging directly with potential customers. The cons is that the success can be uncertain. Crowdfunding success isn't guaranteed, and it requires significant marketing efforts to attract backers. If your campaign fails to reach its target, you may receive no funding at all. Next is venture capitalists. These are professional investment firms that invest in high-growth startups or businesses in exchange for equity. Now, pros for venture capitalists are the scalability and growth. Venture capitalists, or VCs, specialize in funding high-growth potential businesses. They provide not just capital, but also guidance and support to help scale your business rapidly. Cons, on the other hand, are equity dilution and pressure for exits. VCs typically demand a significant equity share, which can dilute your ownership. They may also exert pressure to exit the business within a specific time frame to maximize their returns. Next are angel investors. These are high net worth individuals who provide capital and mentorship to startups in exchange for equity or convertible debt. The pros is that they have expertise and network. They often bring valuable industry expertise, experience, and a wide network of contacts to your businesses, which of course can enhance your chances of success. Cons, though, include a loss of autonomy. Typically, these angel investors, they expect a stake in your company in exchange for their investment. And it may lead to a loss in autonomy, as they may have a say in important business decisions. If you've ever watched Shark Tank, those are angel investors. All those sharks are angel investors, and they have these same pros and cons that you can see from this slide. They offer the money to a startup, to a business, but they also want something in return. So again, Shark Tank and the sharks on Shark Tank are a good example of angel investors. All right, so moving on, small business loans are loans that are provided by banks or other financial institutions specifically tailored for small businesses. The pros include financial stability and ownership retention. They provide that stable source of funding, and you retain full ownership of your business without diluting your equity. Cons are the debt and the interest payments. Small loans, business loans, come with the responsibility of regular payments, including interest on the loan. So it can create financial strain, especially if the business experiences cash flow challenges.